Hello, friends. If you have money sitting in a bank account right now, checking, savings, it doesn't matter. There is a real chance that account could be frozen, and you wouldn't even see it coming. I'm not talking about scare tactics here. I'm talking about actual rules banks follow. Rules most people never read because they're buried in paperwork nobody has time for. And by the end of this video, you're going to know exactly what those rules are, why they exist, and more importantly, what you can do today to make sure you're never caught off guard. So stick with me through this whole video because I'm going to walk you through 5 real situations where a bank can restrict access to your own money legally and often without much warning. And for each one, I'll tell you exactly what to do about it. Some of these you can fix in 5 minutes. One of them, almost nobody knows exists, and it happens to be one of the most important protections available to older Americans right now. Here's the big promise. This isn't about fear, it's about control. Banks operate under federal and state laws that most customers never see explained in plain English. Once you understand these 5 things, you're not vulnerable anymore. You're prepared. And for a lot of families, especially where aging parents or grandparents are involved, this information can prevent a genuinely stressful situation before it ever starts. Before we get into it, I want you to know this isn't guesswork. These protections come from real sources: the Consumer Financial Protection Bureau, FINRA, the Electronic Fund Transfer Act, Regulation CC, and state-level elder financial protection statutes that have been passed in most states over the last several years. I've gone through how these actually work in practice, not just the legal language, so you get the real version, not the confusing version. Now, if you find this kind of information useful, consider subscribing. The reason is simple. Banking rules and consumer protections change more often than people realize, and small updates can have a big effect on your accounts. Folks who stay subscribed tend to catch these changes early. Folks who don't often find out the hard way, usually from a bank teller instead of from someone explaining it ahead of time. All right, let's get into it. Here's number 1. Number 1 is the fraud hold. And this is the one almost everyone runs into at some point without realizing why. Banks use automated systems that flag unusual activity. That could be a larger deposit than normal, a withdrawal from a new location, or several transactions in a short window. When that happens, the bank can place a temporary hold on funds under Regulation CC, sometimes for several business days, while they verify what's going on. Most people never realize this can happen from something completely innocent, depositing a large check from selling a car, for example, or traveling and using your card somewhere new. The impact can be real. Bills not going through, an ATM card declined at the worst possible moment. The fix is simple. Call your bank before making an unusually large deposit or before traveling and let them know in advance. It takes 2 minutes and it almost always prevents the hold entirely. But that's not the biggest one on this list. The next one involves something a lot more personal. Number 2 is the elder financial exploitation flag, and this is where things get more serious. Over the past several years, most states have passed laws, often modeled after the North American Securities Administrators Association's Model Act, that actually require or permit banks to delay a transaction if they suspect financial exploitation of a customer who is 60 or older. That means if a bank teller sees a withdrawal pattern that looks off, or notices a new person suddenly involved in someone's account, they are legally allowed, in many states, to pause that transaction and report it to state authorities, even without the account holder's permission. Here's where it gets interesting. This law exists to protect seniors from scams and exploitation, but it also means legitimate transactions can occasionally get flagged too, especially if a family member is helping manage finances and the bank doesn't have that relationship on file. The people who get caught off guard are usually the ones who never told their bank who their trusted helper is. And that leads directly into the most overlooked protection on this entire list. Number 3 is what's called a trusted contact designation, and this one might be the most important thing in this whole video. FINRA, the organization that regulates brokerage firms, actually requires firms to ask customers if they want to name a trusted contact person on their account. Many banks now offer something similar. This is not the same as giving someone access to your money. A trusted contact cannot withdraw funds or make changes. What they can do is confirm your well-being if the bank has concerns, help verify that a transaction is legitimate, and give the bank someone to call instead of freezing your account outright. Most people never realize this option exists because it's usually mentioned once in fine print when an account is opened and never brought up again. The financial impact of skipping this step is significant. Without a trusted contact on file, a bank facing a red flag often has only one option left, which is to pause the account until they can sort it out themselves. Adding a trusted contact takes minutes, usually just a phone call or a form, and it can be the difference between a quick phone call and a multi-day freeze. But even with a trusted contact in place, there's still one more area that catches people completely off guard, and it has nothing to do with fraud at all. Number 4 is the dormant account rule. If an account has no activity for a certain period, usually somewhere between 1 and 5 years depending on the state, banks are required by state escheatment laws to eventually transfer those unclaimed funds to the state treasury. Before that happens, though, many banks will restrict or limit access to the account, sometimes charging inactivity fees along the way. This mostly affects older accounts people forget about, a savings account opened decades ago, a small CD that matured and was never touched, or an account kept open just in case. What surprises people is that the money isn't lost, but getting it back once it's been sent to the state can take weeks of paperwork instead of a simple visit to the branch. The fix here is straightforward. Log into or check on any account you haven't touched in over a year, even something small, and make at least one transaction to keep it active. It sounds almost too simple, but it works. And the final item on this list may be the most important of all, because it involves something that catches even financially savvy people off guard. Number 5 is the large transaction reporting rule. Under the Bank Secrecy Act, banks are required to report cash transactions over $10,000 to the federal government through what's called a currency transaction report. This isn't optional for the bank, and it isn't about suspecting you of anything. It's a standard reporting requirement. But here's what most people never realize. This can also apply to transactions that add up to that amount across a short period. And banks are trained to watch for patterns that look like they're intentionally avoiding the $10,000 threshold, something the law calls structuring. If a bank's system flags a pattern like that, even completely legitimate activity, like slowly withdrawing savings for a home renovation, can trigger a hold while they confirm everything is in order. The best way to avoid this entirely is the same advice as our first point. If you're planning a large cash transaction, whether it's a deposit or a series of withdrawals, tell your bank ahead of time. A short conversation with a branch manager can prevent days of frustration later. So let's bring this together. 5 real situations, 5 real reasons a bank can restrict your account, and 5 ways to stay ahead of every one of them. Fraud holds can usually be prevented with a simple phone call before unusual activity happens. Elder exploitation flags exist to protect you, but they work best when your bank already knows who your trusted people are. Trusted contact designations are free, quick to set up, and one of the most underused protections in personal banking today. Dormant accounts can be reactivated with something as small as a single transaction. And large transaction reporting is nothing to fear as long as your bank knows what's coming before it happens. None of these protections apply automatically just because you know about them now. Every single one of them requires you to actually take a small action, a phone call, a form, a quick login to an old account. The people who avoid these headaches aren't the people with more money or more complicated finances. They're the people who took 15 minutes to set things up in advance. If this video helped make sense of something that's usually buried in confusing paperwork, do me a favor and hit subscribe so you don't miss the next video where we break down another part of the system that affects real people every day. If you know someone, a parent, a grandparent, a friend, who could benefit from understanding this, share this video with them. It might save them a very frustrating phone call down the road. Thank you for watching, and I'll see you in the next one.